Top of the morning to you traders. Welcome to the new week. Good morning, Kay.
Good morning, Ryan. I hope you had a great weekend.
Yeah, lots of barbecuing this weekend. Did one, had some friends over, and then went to the brother-in-law. So yeah, I'm all charcoaled out and stinking of smoke still. You?
Nice one.
How about you?
Yeah, actually relatively quiet, but we did a lot of gardening. So testing my green hands for a little bit.
The old green fingers. Yeah, we're going to be getting some hot weather this week, I think. Forecast.
Yeah, absolutely. But then the next
hot weather
weekend,
this week, and
I hear
probably
it's
start raining.
Next weekend, I hear it's going to be pissing down again.
Yeah, probably. It'll be hot all week while we're stuck indoors, and the weekend when you want to get down the beach, it'll be pissing down. Such is the way. Right, but anyway, let's crack into it. We're having a fairly volatile start to the week so far. A few breaks going on in yields, dollar yen having another go at 135 and cracking it. So we'll get over with the headlines that have been happening over the weekend, overnight. Just quickly on the French election, not getting too much press anywhere at the moment, but after the first round of the parliamentary elections this weekend, it's pretty neck and neck between Macron's Ensemble group and the more left-wing NUPES group, if I'm saying that correctly. Projections are, or the result is that they've both got around 25.7% of the election. This is just the first round, with the second round to come. So it's a bit closer for Macron than he might like. He needs a majority of, or he needs 289 seats to get an overall majority. It's potentially looking like he might get that, but it's going to be close. As I say, the market not really paying much attention to that, but if it does come to effect, it's a bit of a hung situation. We might see the euro or some traders pricing a bit of political uncertainty from France, much as like we've seen in the UK. Because if he doesn't take all the houses there, then it makes it a bit difficult to start passing policies, and that sort of thing becomes a bit more of a bum fight in French politics. So, as I say, early times, it's looking a bit even in the first round. We need to see what happens in the second round. Moving on to China, testing has ramped up this weekend, as we knew last weekend. A bit more happening in Beijing now. One of their most populated districts. There's been some compound lockdowns, and again, as I say, more testing going on. Shanghai is obviously doing a lot of their testing. There's been an outbreak in Beijing from a particular bar restaurant, and they're worried about that. So the talk from the officials over there is a bit more worrying than it has been of late. A situation again that needs to be monitored, because it's, as we know, the impact on supply chains and things like that, having an effect on the knock-on effect on the global economy and stuff. So that's still bubbling over. Over to Japan, there's been more waffle from officials, both at the Bank of Japan and Suzuki, the finance minister. Kuroda was out saying that sharp falls are more negative for the economy, but it was still pretty light in its tone, just saying it makes it hard for businesses to plan because of the change in rate. Suzuki perhaps gave a bit more of a step up in the weak yen. He's saying he's seeing a more negative side of yen weakness. Again, it's just a minor little step up in rhetoric, but it could mean that as they're watching the price move up, we may get to start getting to a price level at least where we start to see that sort of chatter increase. I'm still of the mind that we have to wait until we start getting comments about speculative moves. That'll be pretty much the cruncher, but that won't stop them from continually coming out and making these sorts of comments and just taking those little steps up. So it's a snowball at the moment, and we need to keep an eye on where that's going. Over to the UK, we've got Brexit in the front and centre again, in case you've been missing that, with this Northern Ireland Protocol stuff. There's been a couple of conversations between Liz Truss and European counterparts. So far, as you can imagine, the talk from the European side is that this is all negative. breaches of international law, blah, 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 blah. And we'll see what happens in Parliament when Boris drops the actual details of this stuff and how it's taken in Parliament. But again, another ongoing situation to keep an eye on. A pretty dour press overnight, talking about the economy might suffer, the UK economy might suffer with high inflation. Lots of negativity in the press about that, an ongoing situation. And we're seeing the pound, a bit more offered than the euro dollar on this sort of news. But we've also got a bit of volatility difference, which I'll talk about in a moment. Now, obviously, the big feature, well, obviously with the Bank of England coming up this week as well, that's going to be something to keep an eye on, and what the Bank of England say about rate increases, further rate increases. 50 pips, I think we're expecting, or the market's expecting to come this week. We'll see whether that happens and how the Bank of England set out the path and how they'll deal with the potential problems of the economy that rate hikes bring. But the bigger story is obviously going to be the Fed this week. And what I've really been seeing is a lot of expectations, particularly from banks, getting into sort of the extreme period now, or extreme point. When you get banks and we're expecting 50 pips, but it seems like a lot of the market now potentially expecting 75 pips, if not this month, next month, or at least in the near future. We've even got some banks calling for 100 pips this week. So in my mind, just as you listen and you read all the headlines coming out and the bank expectations and analysts and all that sort of thing, I just feel we're moving into extremes of pricing now, where everyone's getting a little bit too excited about what the Fed might do, a little bit too hawkish. And as we mentioned with the ECB, it's looking at where the at least the very short-term expectations lie, which then gives you your bias for where the bigger price risk is into the Fed. So in this case, we know they're going to hike 50 bips. That's pretty much nailed on. But if the market is now looking a bit more hawkish, they want something a bit more hawkish, and the Fed don't deliver that, that's when we see a big turn in short-term price moves. You see dollar yen coming off, yields coming off. So the path of least resistance is down rather than up. So we could get a bigger move down in dollar and yields on disappointment than we would if the Fed signal that they're going to be looking at higher hikes further out. One thing that we are seeing today, and these sort of things always get headlines, it's an inversion in the 2-10s spread in the US. This is when 2-year yields rise above 10-year yields. And it comes down to the usual factor that potentially signals a recession to come. It's really a no shit Sherlock situation that we should see the US economy falter as a result of higher rates. That's what the Fed's plan is, basically, as we know. So the fact that yields are potentially signaling that isn't as big a news as the clickbaiters might want you to think. A lot of people are expecting it anyway. But we're seeing that in the headlines and what that means for markets, and everyone likes to make a hoo-ha of it. But you get Ryan, these inversions. Yeah, Ryan, go on, mate.
Excuse me, mate. We only, the screen is blank. Is that normal, or should you be sharing?
I should be sharing my screen.
No, we don't see anything.
It's only the prices anyway. Has you got that now?
Yeah.
Yeah, so I'm only showing the prices there anyway.
Yeah, but it's gone again.
Has it?
Yeah.
Oh, what's going on there?
Now we see your screen.
Now you see it, now you don't. Right. Is it staying there?
Yeah, it's staying now.
Yeah, cool. Okay. As I said about these, these yield inversions and reversions and whatever, there's so many different ones. You got 2-10s, you got 2s, 5s, 2s, 10s, 5s, 30s. There's always parallels to be drawn for this type of thing. Yes, it does indicate a bit of what the market might be pricing, but don't necessarily get sucked into the headlines about all that. What we have seen this morning is just a bit of divergence between the moves in dollar yen and 10-year yields. You can see 10-year yields sitting up near these highs I've got a bit of a level up here, 3.25. Just looking back towards 2018 when yields got up there. So a bit of a level perhaps up there, but yields are sitting up here on their highs in 10s. And as we're seeing in dollar yen, that's not being reflected. So we're not seeing the follow up. We got a bit of that last week where yields were holding and dollar yen made the move up, into 134 and above. Last night we got a break through that 135, so the barrier's taken out up there. Probably a few stops on the way too. The turn came round about the time that Kuroda issued those comments. So whether this is a case of the market getting into his comments and selling off on the back of it, or potentially that was just a barrier stop flush, it's a bit of an unknown now. I tend to think it looks like a barrier stop flush rather than a real attempt to take the level out, but we'll see what happens now. The egg's been cracked. You got any thoughts on dollar yen and that break, mate?
Yeah, I think you're spot on about the rhetoric and then the barrier hunt. I view it as such as well. It must have been a barrier for some Japanese corporates, and looking at the time it got taken out, it might signal that it was around their time where to do it, and then Kuroda came out. I also think the inversion caused a bit of a drop, together with some take profits from by longs. So yeah, inversion of yield curve is not too good usually for risk assets. So we have to be a little careful. As I said last week, I was looking to put up some downside for a surprise later on in the central bank week, but FX options are extremely expensive. So I might just pick a level if we see another move up above 135. Just do a real short term, because otherwise it's going to cost an arm and a leg to do options in this environment, which is not completely abnormal, seeing the number of central banks to come out this week and the volatility in yen lately. But apart from that, that's about it. We will have the verdict at the end of the week, because Bank of Japan is really after all the others. If they really keep their hands still, it could be there could be some nasty moves coming up, perhaps 100 to 300 points shot up in dollar yen. Inversely, if they start to talk about normalization, then we could see a move back down to, why not 132, 135, 131, where we took off from. But expect volatility in the yen this week again. That's about it. Yeah,
that's it, mate. So looking at dollar yen here, we had this break up above, this 134, 40, 50 area. Had the break back now down below. We had found it as a bit of support. We're now back below. So at the moment, it's a bit of indecision going on here. Are we going to get it back above? Are we going to hold below? So in terms of price moves, it's looking a bit similar to what we had when we came up. And we had that 130, 131, 127 moves previously. So we're looking to see what's going to happen. Are we going to develop another range here? I've got 133, 132.90 as a bit of a line in the sand to perhaps see the bottom of that range there. So are we going to build a range here between now and the BOJ, obviously with the Fed involved in the middle as well? On the volatility front, I showed this, I think, the other week. One of the reasons why the options are so expensive to trade is because of the higher volatility. I tend to look at these 1 month at the money option levels, and dollar yen up at near 13%. That is quite high for this pair. So that just shows that the volatility is well in play here. And that can make for some choppy moves, as I explained before. When volatility is running sub 6%, you're getting 10, 20 pip moves a day. In this case now, when you've got vols up this high, you're going to be seeing moves, perhaps 20, 30 pip clips at a time. So that's why I watch these vols, just to see, get the lay of the land, how volatile things can be. As you can see, cable is, yeah, go on, mate.
Can you click on the 1 month yen? Just click on it, because then it brings up another window. Yeah, this one. If you look at the implied volatility there, the current versus a week ago versus a month ago, usually we see in normal situations, because when the Japanese corporates are usually exporters, we should see the volatility for lower strikes being higher than the volatility for high strikes. But since the whole story here developed over the past month and a half, this thing has reversed. And okay, now it shows like the smile is relatively normal, as we call it, but yet the volatility is slightly higher for the higher strikes, and the higher and the calls, which is which still means that the market is still a bit afraid more of the top side than the downside for now. Just another read about what we can read out of options when it happens, because in normal times there's always more protection going on for the downside than for the top side, and this has been inversed in the past month and a half.
Yeah, and I'm just going to show that actually while we're looking at that. This is another side. This is the options view of dollar yen for this week, and it's very low. You know, the strikes are very low. If we look at this, this is the total strikes this week. So where you've got this one here, around about 130.31, I think. Sorry, 129 odd. Just over 1.2 million is very low for this pair in particular. You know, reasonably quiet days usually maybe 3 to 4 billion, but we're seeing very low activity in dollar yen particularly. And as you can see, as Kay mentioned, you know, all the strikes are mainly to the downside. You know, got very little up here above 135, 134, very little at all. And as you can see, although that one, that big strike there, which is, as I say, probably about 129, 129.50, well, actually, there it is, 129.25, 1.16 billion. So most of that big strike is tomorrow. And as you can see, very little. Now, what do you think the reason is for that, Kay? Do you think it's? I
think the volatility is shooting up. People not prepared to see levels above 130 until the last couple of weeks and months, and the market taken a little bit by surprise. Also, I reckon because that's not taken up in there, but that will have more to do with barriers. I think usually the exporter community is putting up a lot more strikes in the dollar yen and barriers than the importers would do. They usually traditionally, historically, just go to market and buy it. So that might explain a lack of higher strikes, but I do think it's well, for one, the market's surprised, and for two, because they are surprised, the vols are shooting up, where normally a market in dollar yen is trading around 6, 7, 8 vols is already a stretch at times, but now we see vols of 13 and above. It does scare the players away.
And I suppose it's a bit of a double-edged sword as well, because it then becomes, if you haven't been hedged, or you haven't you know, had coverage this high up and you've been caught out by these moves, if you want to start hedging, A, you're going to be chasing the market, and B, you're going to be paying more because of the higher volatility is increasing the price. So it's a bit of a double-edged sword. But do you also think maybe some of the Japanese whales, where they're going a lot of unhedged stuff this year, that's another reason why big activity?
Also possible. That is what they said, right? Around that they would unhedge a little more, and that's also one of the reasons why we are up here. The market didn't really expect them to drive the market this far. So now you might be having a situation now where there's just no sellers left anymore, which I think was the case between the first time we shot up to 131, and then perhaps now another leg. But you won't have too much chasers anymore. So now I think it's a case of volatility. We might hold and stall, but it's going to be like the 131, 137. We are going to move probably between 200, 300, 400 pips ranges. That is very possible.
Yeah, and I guess that's what we're coming to with all this. Some of you guys and girls may not look at options a lot, may not understand options a lot. The real take from this is just that volatility is higher. So, you're going to have to expect to see bigger and faster swings. If headlines come out, if there's a comment from Kuroda, from Ministry of Finance or something like that, it has the potential to move this a lot more than it did in past years where, as I say, 10 to 20 pip moves a day, whether, 2017, 2018 into 2019, we were sitting there picking our noses in a pair like dollar yen because it just wasn't moving. But now we've got this volatility. Now we've got potential where the option market is lacking. It just can cause prices to move a bit more. And we're probably going to see that a lot over the Fed. With regards to the Fed, Kay, what do you make of these expectations? Do you think they're starting to creep a little bit too much to the hawkish extreme, particularly from banks and stuff?
Yeah, I think 100 is I think that's a call to say I told you so. That is just make the outside call and differentiate yourself from all the rest. That's what I think. I can't see them do more than 75, to be honest. Now, is there a risk for 75? There certainly is. It's kind of a risk play, right? What do you attribute the 50 BPs to? How much do you attribute to the 75? And then you've got the 1, 2, 3% chance of 100 BPs, and that's what's kind of reflected in those short-term rates with the 2 and the 3 years shooting up above 320%. And because they take the probabilities into account, but I mean, personally, I don't think we see more than it is a possibility, a real possibility. They do 75, but what's more important, I think, with the inflation numbers that we saw, supported by the prior week, a bit stronger than feared labor report, we have to price out these polls perhaps in September, and that's, I think, what's behind most of the dollar rally that we saw in the past sessions. And the fact of the matter as well, that now equity markets are starting to take the thing into account, because we lost 300 points in the S&P over the space of a week, and we also see the emerging markets now starting to take the whole thing into account, where until midweek last week nothing was happening. All of a sudden the MEX and the Canadian dollar have lost quite a bit. MEX is up 2.5%. The dollar rand shot up like 4% in the space of half a week. So the market is repricing the whole thing, where we said that, okay, they might be doing a pause. They're pricing the pause out now. Of course, the chance of a 75 BPs in there, looking at the inflation, is real. Now, again, is it a buy the rumor, sell the fact? We'll have to wait. But don't forget, we still have like 2.5 sessions to fully price in the buy the rumor. So I'm not prepared to completely start counter trading it. If we see some kind of peak expectations and let's say, for example, euro dollar goes back down to 103.5, dollar yen shoots up to 136, 137, then I would really start to think about trying to counter trade this. For the time being, I'm still trying to accompany the dollar moves rather than counter them.
Yeah, exactly. I agree on that entirely. And it's funny you mention that, because while we're getting to peak extremes potentially in pricing, you look at the news just out, and some traders in the market already betting on rate cuts for next year and 2024. This is such a bonkers world we're living in. It's such a goldfish mentality. We never used to swing so fast between banks on a rate hike path and then starting to price in potential rate cuts. But we're getting all these calls for rate cuts really at the start of banks' hike cycles. You know, like the RBA, they're 2 in. The Fed are 2 in.
And ECB hasn't started yet.
And the ECB hasn't even started yet, and they're going to be pricing in rate cuts. You know, it plays a havoc with trying to trend trade, because you think, well, am I trading a hike cycle, or am I starting to trade a dovish cycle? You know, it's bonkers. And
that's something that for old rats like us, even that we are not used to see. We used to see plain cycles who took 5, 7, 8 years. Now we are doing everything in 2 years' time. So it's everything is accelerated. I think we will have to adapt to such scenarios going forward, because imagine that now they hike 75 and then 50, and then even ECB hikes 50 perhaps a couple of times, because that's what the market is pricing in now as well. But then if imagine that the data really turns sour, then it's going to be we are going to go through a deep trough, I think, in equity markets, but in a very fast way. It can go really, really, really fast. And then, yes, the market will start to price slowdowns again. Imagine that we drop through 3,400, 3,350 on the S&P. It would be really, raising alarm bells, right?
Yeah, and it's it must be difficult for investors, because, like you say, when back in the old days, we call them the old days, not that so long ago, 10, 15, 20 years ago, like you say, when you're in these cycles that last 5, 6, 7, 8 years, investors position for that, and they put their money in. They can park their money up for that period of time, and they know their investment path particularly. But if you've got now half the market trading rate hikes and half the market starting to price in rate cuts, how do you play that as an investor? Where do you put your money?
That's your curve inversion. Huh? That is what that's where the curve inversion is. Look at the 20 years has been above the 30-year long end already for quite a while, because the long-term investors were kind of looking at that and the hedging costs and stuff like that. But now even the 10 years is approaching the 30-year. There's only like a couple of BPs left in between, and that's, I think, is what the investors are trying to do, is to hedge via the longer end of the curve. But where the big difference is that they need to react within days or weeks, where usually they are reacting in the space of weeks to months.
Yeah,
the reaction time has been cut by 5.
Yeah, long-term investors can't have a 5-year plan now. You can't stick your money somewhere and think that's what's going to happen to Fed rates over the next 5 years. Park your money and you make the usual adjustments as that goes along. You can't do it, because 5 minutes later it's changing.
Yeah, and
then you've got to think, well, my 5-year plan might only last a year and a half, 2 years. What do I do after that? And then what happens after that? It's bonkers, and that creates, for us trading, that creates additional volatility.
Additional uncertainty, but also if you can do it on a short term enough, and us FX traders, we can react on a dime. It does create opportunities as well, because the moves are faster and the volatility is higher.
Yeah, definitely. Yeah. So that's the life of a forex trader. So what do you folks think about hearing you viewers about the Fed? Are we going to are they going to stick to 50 basis points? Are they going to go higher this meeting, or signal higher hikes to come, 75, 50, 100 BPs, September onwards? Let us know in the comments what you think. Mike's made a point. There is a disconnect between banks calling for 75 pips and the feeling here in the US among traders knowing Powell will not want to shock the markets. I think that is going to be the case. My view of the Fed at the moment is that they're going to stick to their path. Maybe they will not shut the door on higher hikes, but I think at least in the interim, they're going to say, this is our path, 350s. Then we're going to maybe see what the economy is doing. They don't switch as quickly as bank expectations and market expectations, that sort of thing. They tend to be much slower, central banks. They let things play out. So I think if we've got these more hawkish expectations. And it's not the whole market, by the way. You know, some of these bank expectations are a bit clickbaity as well. So take that into account. But if you've generally got a more hawkish view, I think that's where we're heading. And the Fed, by staying on their path, is going to disappoint those. That's my view. I think we're going to get 50 hike, leave perhaps 75s on the table, but not too strongly, and keep the path 50-50 for the following months. And then we'll see where we're at into the end of the year. So I'll certainly be looking for the potential for that to happen, and then to maybe counter trade some of these higher expectations. Now we have got it's the S&P as well this week, isn't it, mate? And another one, is it 16th, I think?
Yeah,
the S&P.
Yeah.
And another one where we've got expectations tilting to the upside. I mean, a lot of market is thinking that we could get a 50 pip hike off the S&P this week. You know, we've definitely got a big level up here in the 105s. I know one of our guys in our room absolutely smashed that up there the other day, last week. What do you think from the S&P? Are they going to signal a hike, or are they going to stick two fingers up at expectations like they usually do?
No, I think they can start to hike, which would be something we need to really be careful with this Euro Swiss. I think because if they hike psychologically ahead of the ECB, because usually they would wait, right? They would wait for the ECB to move. Because they went even deeper. But the S&P bots have been signaling that they are willing to start to normalize. So they could do something this week. I would not think, I'm going to stick my neck out, that they would do a 50 straight away. But okay, chances are that they do something. Yeah, we had this move up to 105. I completely missed it because I was, well, first of all, looking at something else, but I missed it up there, but because I think the S&P, and we talked about it on our chat, is really trading this Euro Swiss both ways, because they have to manage their FX reserves. They cannot just continue to buy euros and print Swissy. The Swiss government is still supportive of the S&P, but the local authorities are starting to cough a little bit. So I do think they are really both ways. 105 could have been a level where they were sitting on top. But watch out if they really move ahead of the ECB, because that would be some signal sent to the markets, in my opinion. So more than okay, if it's 50, it's a gigantic surprise, and then I don't know where Euro Swiss stops. So then they will have to really intervene very, very hard at parity, in my opinion. But if even they do 25, the signaling that they start ahead of the ECB is already going to weigh on the market, in my opinion, psychologically.
Yeah, it's
so
also
102, 105 basically. That's the thing.
Yeah, it's also worth noting
the boundaries.
The S&P only have a policy meeting 4 times a year, every quarter, basically. So it's March, June, September, effectively the futures months. I don't know if that was planned like that, but technically, yeah. I mean, you can see there the importance of this 105 level. It's a level we looked at as we came down to there in previous years. Even going back to this area immediately after they pulled the cap, 105 has been, it's been a number that's been significant in the price action. So here we are again, seeing that happening in this level, which makes it such a big one. I think potentially if we do get a big hike, if we get a surprise hike, 25 pips, even 50 pips, as Kay says, I think any significant dip, they're going to be sitting there intervening, at least smoothing things, and rather than hooving up huge amounts, they'll probably just smooth it on the way down, let the market sort itself out, then potentially sit down here, maybe into that parity mark again. I'll be very tempted if we get a move down there to stick on a couple of small longs, just on that basis, to see if they are going to come in with support. But as we know from the S&P, they don't often like giving a free lunch. So if we do get down to that parity level, I wouldn't be surprised to see this type of action, a little breakthrough, you know, clear out those who are thinking this is a free lunch, before then, you know, starting to move it back up again a little bit, or be a bit firmer with intervention. So that might be one to look at over that meeting. 8:15 in the morning, UK time, I think it is. That's what, 9:15 European time. I think the announcement's out usually from them guys, so quite early in the morning. Let's have a look at some of your comments there before we look at something else quickly. Let's have a look. Richard, I assume that you don't think they're going to be going much hawkish. Dom says equities dumping, so he's thinking 50 pips. Gavin thinking to stick with 50 pips, but door open to more. They are doves at heart, so 50 BPs from Charles. Brian think they'll exercise restraint. So none of you guys getting out your prams over hawkish expectations, which is good to see. Keeping your feet on the ground a bit, and we'll see what happens. Yeah, looking at stocks just quickly. Let's have a look at the old S&P, the old favourite S&P, nudging down onto this 38 handle again. Could be a bit of a crunch point. You know, we're not cracking it at the moment. We had a prior test down there. It's a 38.2 fib of the let's call it the virus bounce, or the post-virus bounce, after we got the initial flush out there. Big, huge level there. Again, I think my view on stocks is that this is something that's more of a repricing of companies, if you like that. It's the end of QE. We're entering QT. The market's now got to stand on its own 2 feet. That means that performance of companies actually really matter more than whether the Fed are going to prop them up. That's part of this move, I think, but also this growing vibe that economies are going to suffer with these rate hikes, which will naturally play into the performance of companies anyway. Is feeding in here. But if we manage to hold this level, that will cement my view that we're just in a bit of a reprice in how stocks are going to trade going forward, rather than a big crap out. But if we do break that 38 handle, it could be that we see a very swift move, you know, maybe down to the 50 fib fairly quickly. You got any thoughts on stocks at the moment, Kay?
Yeah, I think that's what we've been saying, right? We had to reprice something from the lofty levels that the stocks were priced at. It could not really continue to go the way it went unless central banks were injecting, but that is coming to an end now. So to me, the real test will be when QT overtakes the rest of the maturities now. I think it's next month or so, and then at the same time see what the Fed is doing, and then keep an eye on the pre-COVID spike high around 3,400 in the S&P. If it goes below there, we might see less support for Fed action from a political side, perhaps in the US. Until then, yeah. I do think that Fed and Powell, as he said, we may have to take some pain, is they are okay to let it drift back down to 3,400. I think it would rather be panic stations if we go back. They will have a look at this, and then it would be panic stations if we get back below 3,200. Then I think it's panic stations, and we will see the rhetoric change dramatically. Yeah,
no, I think I agree with you on that. Richard says the US opening bell sentiment probably will change for today. Yeah, I think it's going to be an important open. You know, we so often we've seen situations where futures indicate, you know, heavy losses and the market looks really crap, and then the bell goes and everything jumps, and it completely changes around and catches everyone on the wrong foot, and everyone then scrambles to get out of shorts. So I think that is going to be something to watch today. What I'm also, I don't look at this often, but I'm going to look at Bitcoin. I think, if it's not blatantly obviously already, I think we're heading for the point potentially where the crypto world is going to get its arse handed to it. I think we're at the .com area where the pin's going to come in and burst the bubble a bit. You know, if I keep a crypto stream on TweetDeck, and all the tweets that come through is about how people aren't realizing that they're actually going to be doing their asses if they keep up this hodl mentality. I've been saying for a long while that before this let's call it an industry really takes off and becomes something, it needs to get rid of the shit. And when you've got, I think it's 36,000 different crypto coins in the world, it's got to be flushed, and then the strong survive and the strong come out. I know Stel in our room's been going on about this morning, similar things. I think we might be heading there. You know, if Bitcoin keeps crapping out, if it gets below 20,000, it's going to be taking a lot of people to cleaners. It's going to be margin calls aplenty, and you know, other coins, sub coins, the lesser coins, whatever you want to call them, shit coins, they're all going to get wiped off the face of the planet, and we're going to have a big reset in this market. But you know, I'm not one to call doom and gloom on things like this, but I think we're heading there. How long that takes is the question, but we're on the way, I think. And that's when, if you're looking at getting into cryptos, that's when you might start to bargain hunt, and you start getting the Amazons and the Googles of the crypto world starting to come to the fore and take up. For me, it's always been about the technology, not about the coins. It's always been about the technology that potentially gets picked up by governments, by central banks, in the mainstream. And if you can get into that sort of thing, that's where the long-term investments are for my 10 cents or my 10 Bitcoins. But this is something to keep an eye on. 20K is going to be a big psychological level. I'm surprised our mate still isn't questioning Michael Saylor and his margin level. What was that? 29K was his pain level K?
I have never followed that. Never. I don't know. 28?
Might have been something like that. I'll ask Stel when we're back in the room. Right, so let's call that a day for today. It's Monday. We're all getting into the swing of things. We've got plenty to look forward to, plenty in the build up to these central bank events this week. We'll see what today develops. As always, I think I hope you have a very good week, a very safe week. Take care. If you're not sure about trading the Fed, don't guess. You can always sit on your hands, let the dust settle, pick up the pieces after, and go with that. There always can be amongst traders. You know, it's a big event. You want to jump on it. You want to get on the volatility, catch the big moves. But if you don't know where the big moves are going to happen, sometimes you just need to let the event pass, pick up the details. Then, if you can get an opportunity to get in for the longer term or a longer term trade, you know, a couple of days maybe, that's what we tend to do. But anyway, I wish you all a good week, and we shall scroll around back to this tomorrow. See you later.
Have a good week, all.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.